Hello and greetings everyone. I hope everybody's having a fantastic day today. In this video today, we're about to discuss some misconceptions in the crypto space. 99.9% of individuals that are within the crypto industry have a misconception of certain things that we want to discuss in this video. And by the end of this video, hopefully, we'll be able to establish the fundamentals and the core values that we should really pay attention to within the crypto space. This video serves to inform, educate, and inspire you. With that said, let's get one thing out of the way. We are all in this crypto space for one reason. We are in it for the technology. By the end of this video, hopefully, we will all be on the same page and agree that we literally are in it for the technology. The misconceptions we want to get rid of is that in the crypto space, the value of a cryptocurrency is based on its price. That's a misconception. The value of a cryptocurrency is not based on its price, but rather on its liquidity. This gets us right into the conversation. First of all, cryptocurrencies have failed the test of digital money. This is based on MAS. This is the Monetary Authority of Singapore. This is the US equivalent of the SEC. They said that cryptocurrency has performed poorly as a medium of exchange and a store of value. So let's establish something here. First of all, first thing when you come into the crypto space, you need to ask yourself this question. These are the two most debated categories. Ask yourself, is the cryptocurrency I'm involved with, is it supposed to be a medium of exchange or is it a store of value? So once you establish that, you need to understand its functionality. So functionality of the cryptocurrency is very important. What's its purpose? So once you establish that, let's start with medium of exchange. The reason why the Monetary Authority of Singapore said that cryptocurrencies failed to be a medium of exchange or a store of value, let's not just take their word for it. Let's fact check them. Let's start with medium of exchange. How is cryptocurrency not a medium of exchange? First of all, let's establish what is a medium of exchange. Best example of a medium of exchange is the fiat or a stablecoin, right? A medium of exchange is supposed to be a unit of account that we can all agree on. So it has to meet certain criteria. It's supposed to be stable and it's supposed to be liquid as well. And this is what the Monetary Authority of Singapore also identified, is that this is the reason why stablecoins and not cryptocurrencies will be part of a financial ecosystem in the future. And of course, you might say, well, stable currencies can depeg. This is why we specifically talk about the ones that are well-regulated stablecoins. Which ones are the well-regulated stablecoins? Right now, currently, the top stablecoins are USDT, Tether, and USDC. USDT is the third largest cryptocurrency by market cap. It's at 96 billion. USDC is at 27 billion and it's the sixth largest cryptocurrency. From these two stablecoins, USDC is the one that is the most transparent so far because, first of all, its reserves are managed by BlackRock, which is the world's largest asset manager. And they're the ones managing USDC stablecoins reserves. With that said, USDC is a very well regulated stablecoin. Now that we've established what a medium of exchange is, and we picked USDC because it's the most transparent so far, the most regulated one, and its reserves are managed by the largest asset manager, BlackRock. With that said, let's look at the second one, store of value. The only store of value currently within the cryptocurrency space is obviously Bitcoin. So let's look at Bitcoin. What qualifies you to be a store of value? Like the name already suggests, it's supposed to store value. So the Monetary Authority of Singapore claims that this is another thing that cryptocurrencies failed in. So let's fact check them. Let's go to our store of value, Bitcoin. Okay. So Bitcoin right now, obviously we all understand Bitcoin is the largest cryptocurrency. It's the number one cryptocurrency in the space. And if we look at it, what qualifies you to be a store of value? Store of value means you have to be at least deflationary, if not scarce, and you have to have deep liquidity, because you have to store value, right? So this again just shows you that to be a store of value, don't focus on the price of the cryptocurrency. To store value, price is irrelevant. To store value, what's important is the liquidity, because the value of a store of value is not its price, but its liquidity. So with that said, now we really realize why the Monetary Authority of Singapore claimed that cryptocurrencies failed to the test of being a store of value. Because even though Bitcoin is hailed as being the store of value in the cryptocurrency, it failed the test. Because if we look at it right now, let's fact check. Let's go even further. Currently, there are 6 Bitcoin billionaires right now. Right now, the liquidity is at 961 million. So it's right below $1 billion in liquidity. So these 6 Bitcoin billionaires, and this is roughly, okay, they are only billionaires on paper, obviously, because there's not enough liquidity for them to really become billionaires. And another thing that we have to look for is also, in addition to the 6 billionaires, there are also 78 so-called centimillionaires, meaning they have over 100 million worth of Bitcoin. So that means if only 8 of them decided today to shift the assets somewhere else, it will crash Bitcoin. So this is just to make a point that even though majority of Bitcoin maxis, all they care about is price go up, they focus so much on the price of Bitcoin, but they miss the true value. If you want to be a store of value, don't focus on the price of it. Focus on the liquidity, because that's the true value. 6 billionaires would not be able to cash out. So how is it a store of value if there's not enough liquidity? So this is why the Monetary Authority of Singapore said cryptocurrencies just fail the test of being a store of value or a medium of exchange, and that it's the stable coins that actually have a much more relevant function and will play a major role in the future of cryptocurrency. And also one thing I need you to understand is stablecoins play a major role also because whenever you're ready to cash out and to bring your earnings into the real world, guess what? You have to go through stablecoins. So this again shows you that all these thousands of cryptocurrencies that are in the industry, everybody has to pass through a stablecoin. You can either send it to your crypto debit card or transfer it to your bank in the real world, whatever you want to do, but either way, it has to go through the stablecoins to off-ramp your funds. In order for stablecoins to achieve that, they have to be liquid. They have to have the liquidity to be able to sustain all the cashing out off of all these different cryptocurrencies. So this is another indication that liquidity is the true value. And especially if you want to be a store of value, you need to store value, meaning you have to store liquidity, because the true value of a cryptocurrency is not its price, it is liquidity. Now we've established 2 things. We understand that medium of exchange, you have to have deep liquidity, and deep liquidity brings stability, and stablecoins play that role. So stablecoins are the only so far that really qualify to be a digital money, because they have the liquidity and they're stable. And we are talking about, like we've established, for example, USDC, because they are the most regulated stablecoin, and the largest asset manager in the world, being BlackRock, is the one managing their reserves. Okay, that established. Another thing is a store of value. To be a store of value, you need to be at least deflationary, if not scarce, because scarce is even better. And secondly, same thing, you need deep liquidity, because people should be able to exit their positions. We just identified that these billionaires and centimillionaires, they're just that on paper. They're just paper billionaires and paper centimillionaires. That's it. In real world, they're not, because the real value is not the price of a cryptocurrency, but it's liquidity. So this is why, based on the Monetary Authority of Singapore, cryptocurrencies failed to be medium of exchange and store of value. You notice that both medium of exchange and store of value requires you to have deep liquidity. For medium of exchange, for stability, and to be able to off-ramp or on-ramp, and store of value, you need to store the value that everybody can enter and exit their positions, because there must be liquidity in there. And another thing also is that the way cryptocurrencies work right now is the way you win is by being early in the cryptocurrency and selling on top before everybody else. And this is exactly what's the case here with Bitcoin, because only those that are already bought in early are just waiting for us, the masses, to come in and serve as exit liquidity for them. This is the sad reality. Back to, we are in it for the technology, literally, because if you would use the technology the right way, you can develop a token that benefits not just those who came in early, but those who even come in later. And that you can achieve that based on token economy or tokenomics. This is the whole purpose. This video is to just highlight that the true value of a cryptocurrency is not its price. Everybody focuses so much on Bitcoin's price, but the true value of Bitcoin should be its liquidity, because to qualify to be a store of value, like everybody's claiming Bitcoin is, to qualify to be a store of value, people are supposed to be able to take out their value that they're storing. These billionaires and centimillionaires can't cash out right now. There'll be a run on the bank and it will have a negative outcome. So now we've fact-checked what Monetary Authority of Singapore said, and now we identified why they claimed that cryptocurrencies fail to be digital money because they're not a medium of exchange or a store of value. So now, like we established at the beginning, we are here for the technology. And this blockchain technology, if used the right way, we can solve these issues, we can solve these challenges that we just presented in a beautiful way using token economy or tokenomics. This is now where Bullrun comes into play. Bullrun is a utility-driven community token focusing on 4 other major challenges within the crypto space, which is liquidity, education, security, and social network. But for the purpose of this video, we're going to focus on liquidity because we identified in order to be a medium of exchange or a store of value, either way, you need to have liquidity. And liquidity is the true value of a cryptocurrency, not its price. Now that we've established that liquidity is the true value of a cryptocurrency, second thing you need to pay attention to is that the usage of your cryptocurrency, which is the trading volume, should be tied to its value, and its value is liquidity. So these two should go hand in hand, meaning the higher the volume, the higher the liquidity. That's how it should be set up in an efficient way. If you use the blockchain technology the right way, like we established, we are all here for the technology, right? So if you use the technology the right way, your usage of your cryptocurrency, which is in the form of trading volume, should be tied to the value, which is the liquidity, and not the price. It should be in the liquidity. So with that established, let's look at our tokenomics. The way we retain liquidity, we retain it in 3 different ways. And the most obvious one is through the taxes. We have a 6% buy and sell tax. Half of that go towards retaining liquidity. The second way that we retain liquidity is we took 10% of the total supply and we staked it on the staking platform, and we're using the USDC distributions that we're receiving for buybacks and restaking. So we are taking tokens from the circulating supply and injecting liquidity back into the liquidity pool. This is the purpose. This is the second way how we retain a healthy liquidity. The third way is through our NFT staking boosters. These NFTs have utilities. You can stake a maximum of 5 of them to maximize your USDC distributions. If you simply stake your BRL tokens, you'll get 70% of your USDC distributions. However, if you stake a maximum of 5 boosters, you'll have 100% of your USDC distributions. And 100% of the revenue generated from these NFT sales go towards liquidity. So you see that those are our 3 different ways to retain and sustain a healthy liquidity. Now, we go beyond that. We establish that to be a true store of value, you need to be at least deflationary, if not scarce. So this is the reason why we have a 1% true ban. And how does this work? We have a banning mechanism. Because Bullrun is a scarce token, it decreases in total supply. We started with 1 million. Now we've banned more than 27,000. And these 27,000 BRL tokens are completely taken out of the total supply. So we are a scarce token. Besides the scarcity and total supply, we also have a staking platform, which right now is the #1 wallet you see here is a staking contract, and it's holding more than 58% of the total supply. 58% of the total supply is removed from the circulating supply, meaning it also brings more stability to the token, to the ecosystem. And we've established that in order to be a medium of exchange or a store of value, you need stability and you need deep liquidity. We established that right now, the only winners are usually those who get in early and are the first to sell. Using the technology, it doesn't have to be like that. We are a staking platform that is scarce. This is not usual because usually staking platforms are extremely inflationary. So what have we discussed so far? We have 3 different ways to accumulate liquidity. One of them is through the taxes. Second is through the 10% staking of BRL tokens that we put aside, and then through the NFT revenues. We have a banning mechanism that reduces BRL's total supply, and then we have a staking platform that issues not native tokens, but USDC distributions. Another percent goes towards the ecosystem and operations. So now that we've established this, let's go back to Bitcoin. the point of here is that we wanted to establish that the value of a token, it's not its price, but it's its liquidity. So now that we've introduced our tokenomics, let's run some numbers on Bitcoin and show you that using blockchain technology efficiently, it will make Bitcoin a better store of value and a medium of exchange because it will bring stability, deep liquidity, and scarcity. Let's look at liquidity. 3% goes towards liquidity. So let's run these numbers on Bitcoin. Right now we see that Bitcoin sits at 950 million in liquidity. And we identified that the true value of a cryptocurrency, it's supposed to be its liquidity and not its price. If there was a run on the bank right now with the 6 Bitcoin billionaires, or even just with the 78 so-called centimillionaires, Bitcoin would be in trouble. Another key figure that you have to look for is the use of your cryptocurrency should be tied with the value of your cryptocurrency. And the value of your cryptocurrency is the liquidity, because liquidity, if your cryptocurrency retains liquidity for you, there will be no victims. Those who are coming later on are not being used as exit liquidity, but rather your cryptocurrency is using the blockchain technology efficiently to retain liquidity for you so that you're not the exit liquidity. The bottom line here is that we are in it for the technology, and you can use the technology for the betterment of everyone, not just those who came in early, but for those who came in late as well. And this is how BRL is addressing this situation through solid token economics or tokenomics. So let's run these numbers now. Bitcoin is right now at 965 million in liquidity. If they would be using the 3% that goes towards liquidity based on the current daily volume, so if we take 12 billion and we multiply this by 3%, we have 360 million. So as you see here, the liquidity of Bitcoin right now is over 960 million, right? So we just calculated that just based on 24-hour volume, Bitcoin would be accumulating, if they were efficiently using the tokenomics the right way, they would be accumulating 3% of liquidity for the holders, so that those who are coming into Bitcoin later on or FOMOing into Bitcoin are not used as exit liquidity, but the technology is appropriately used to accumulate liquidity so that there are no victims here, but everybody wins. If that was the case with Bitcoin, they would be accumulating 360 million within 24 hours that would be added into the liquidity pool. If we multiply this by 3, just 3 days. So within 3 days alone, we'll be above $1 billion in liquidity, which Bitcoin is currently obviously not. So it will take us 3 days to be above $1 billion in liquidity if we would be using the blockchain technology efficiently by applying efficient token economics or tokenomics. We want to know how it would be in 1 month. So we can multiply this by 10. So we have 30 days, right? So let's multiply this by 10. This puts us at 10 billion. So within 1 month, Bitcoin would have accumulated over 10 billion, close to 11 billion in liquidity. So these 6 billionaires would be able to cash out because now those who came in late are no longer the exit liquidity because the proper token economics have been applied and your cryptocurrency is now using the blockchain technology to retain liquidity for you. So those who are coming later on are not being used as exit liquidity. So these 6 billionaires will be able to cash out, for example, and still there would be over 4 billion, almost $5 billion in the liquidity pool. And all this within 1 month. So you see that if you use the technology the right way and you apply the right token economics or tokenomics, within a month you would solve the problem of retailers who are unassuming and FOMOing into Bitcoin because it hit 50,000, 60,000, 70,000 all-time high. That would be used as exit liquidity because Bitcoin doesn't retain liquidity. It's focusing on the price and putting that as Bitcoin's value rather than focusing on the liquidity. So there'll be a lot of people wrecked and hurt during this bull run. They'll be used as exit liquidity because these multi-millionaires, they'll want to take profits, they want to cash out. And because Bitcoin is not retaining liquidity for them, they will use retail, unassuming retailers to exit their position. You can use the blockchain technology for the good of everyone. We have the technology for that right now. We all should be winners based on how you developed your tokenomics. And this is what sets Bullrun apart. It's built for everyone to win. Are you a trader? Are you a holder? Or are you a staker? It's a win for everyone. And let's continue. Let's look at this further. So we've established that within a month, Bitcoin would be sitting on close to 11 billion in liquidity. And even if those 6 billionaires would decide to sell out, Bitcoin would still be alive. It won't go to zero. And it would still have 4 times more liquidity than it has even right now. This is within 30 days. So let's move forward and let's calculate for a year. So if we multiply this by 12, now we are sitting at close to 130 billion in liquidity. So Bitcoin within 1 year would be sitting on close to 130 billion in liquidity. First of all, this will accomplish 2 things. It will make Bitcoin be extremely stable, not as volatile, and it will allow even those who come in later on to still be safe, because there'll be so much liquidity in the liquidity pool that it doesn't matter when your entry point is. You can come in at any moment, any time, and it's still fine because there's so much liquidity within the liquidity pool. Within 1 year, Bitcoin, using our tokenomics, they'll be sitting at close to 130 billion in liquidity. So that means 130 times more than what they have currently. So this avoids unassuming retailers to be the exit liquidity. Rather, using the blockchain technology efficiently and applying the right token economics or tokenomics, we should be able to protect consumers not to be exit liquidity, but allow the cryptocurrency itself, using the blockchain technology, to retain liquidity for not just those who got in early, but those who will come in later as well. Let's now establish how you incentivize the traders, the holders, and the stakers. So with that said, let's go back and see. We established that you always have to tie the use of your platform to your value, and your value is liquidity. 1% goes to USDC distributions, and this goes to those who decide to stake. So because 58% of supply is being staked, how do you incentivize them for staking? This is where the 1% comes in, that goes towards USDC distributions. And applying the same numbers of Bitcoin, if we do the math again, and we take the 12 billion and we multiply this by 1%, we have 120 million. And before we go any further, Bitcoin is on a proof of work consensus. So meaning that you can't stake Bitcoin, obviously. But because Bullrun is on the Ethereum blockchain, it's on a proof of stake consensus. Staking plays a major role on Ethereum or on any other proof of stake consensus blockchain for that matter. So staking plays a major role to bring stability, like we established, and to secure the network. So 1% of the 12 billion in volume is 120 million. So 120 million, this would be in USDC. And this is the staking platform right here. So 120 million in USDC would be accumulated in this staking platform and will go towards those who are staking their tokens, the BRL tokens. And this is 58% of the supply. These individuals who are staking 58% of their supply, within one trading day, they would divide among themselves 120 million in USDC. So this is how you incentivize those who are staking, just in 1 day alone. So if we multiply this by 30, we have 1 month. So within a month, the Bullrun ecosystem, based on the daily volume of Bitcoin, would distribute $2.4 billion worth in USDC to those who decide to bring stability to the token. 2.4 billion based on Bitcoin's volume. So this is how you incentivize those who stake. And how do you incentivize those who are trading? If those who are staking are busy collecting large amounts of USDC distributions, like we saw here, 120 million in just 1 day, 2.4 billion within a month. And if we do this times 12, let's look at that. Close to 29 billion in a year. This would just organically be going to the community. What platform incentivizes the community for securing the network and bringing stability by distributing close to 29 billion in 1 year to them? This is why we mean with, if we are here for the technology, literally. The technology is here. You can use it efficiently and effectively so that there's a win-win for everyone involved. There shouldn't be only the early ones that are benefiting, and those who come in later just serve as exit liquidity. If you use your technology right and you apply the proper tokenomics, like our Bullrun ecosystem is right now, it will be a win-win for everyone, just like we established. It will be a win for the traders. They don't have to worry about those who are holding the tokens to sell on them, because there's already 58% of supplies being locked away. Based on the daily volume, we saw that 120 million a day in USDC distributions will go towards those who are staking. And those individuals have no interest in selling if they're receiving USDC distributions for just staking their BRL tokens. At the same time, as these trades are coming in, 1% goes towards banning. So 120 million within one day, one trading day, based on the trading volume of Bitcoin, would go towards banning Bullrun tokens. So 120 million worth of BRL tokens would be banned and permanently removed from the total supply. The total supply will keep shrinking while the staking number will keep increasing, and this causes a price squeeze, obviously, where demand surpasses supply. So there'll be less supply than there is demand for BRL, and this will cause a price squeeze, obviously. So this is all done through using the blockchain technology efficiently, with the best intentions to benefit the community. The technology is here and it can be applied properly, but you need to ask yourselves this question: is this cryptocurrency, is it developed to benefit the early holders, or is it developed to benefit everyone that comes in at any time? The way you can answer that question with certainty is by understanding that that ecosystem is not focusing on the price, but rather they're focusing on the liquidity that is within the ecosystem. And this is exactly what Bullrun is all about. One of our 4 major challenges that we are addressing in the blockchain industry is liquidity. So liquidity plays a major role for us. And if you're tired of being the exit liquidity, Bullrun ecosystem does the work for you by accumulating and retaining the exit liquidity with every trade. And it does so through what we just discussed. It bans BRL tokens and removes them from total supply. It issues USDC distributions for those who decide to stake. And then it retains liquidity with every trade. The usage of the platform, which is seen here by volume, is directly tied to liquidity. The more usage of the cryptocurrency, the more liquidity is being added. And that's the whole purpose. That's the whole idea. And this is what sets Bullrun apart from every single cryptocurrency out here. It's focusing on everybody being a winner, not just those who came in early. To demystify those things, the true value of a cryptocurrency is not its price. It's liquidity. That's the true value. And to become a store of value, you need to be at least deflationary and preferably scarce, and retain liquidity so that those who got in early can cash out, and those who come in later on are not used as exit liquidity either. That's how you identify a true store of value. From the very beginning, we used the blockchain technology the right way and developed the token economics that serve everyone. Everyone is a winner on the Bullrun ecosystem. If you're a trader, if you're a holder, or if you're a staker, it's a win-win for everyone. So pay attention to this misconception that cryptocurrencies' value are based on their prices. No, they're based on the liquidity. And I hope this video today gave you that enlightenment and you understand how a true store of value is supposed to be like, and that we have existing technology right now that we can apply that benefits everyone, not just those who come in early, because even those who come in early, they'll rely on newcomers to be the exit liquidity. But why do that if we have current technology that can accumulate liquidity multiple ways through the blockchain technology and the proper token economics, so that it's a win-win for everyone? Whether you're a trader, whether you're a holder or a staker, it's a win-win. Everybody wins. And this is the purpose of blockchain technology. It's made so that everyone wins. And this is what sets us apart at Bullrun. We developed an ecosystem using the blockchain technology, applying the proper token economics so that it's a win-win for the trader, for the holder, and for the staker. And this is what blockchain technology was developed to be in the first place. It should benefit everyone. And we should be a global digital community, borderless, that everyone can participate. The blockchain technology can be used to benefit the common people like you and myself. and we can come together and use a platform that is developed to benefit the trader, the holder, and the staker. And it's a win-win for everyone. We are here for the technology, literally, and the technology is the key to success. If you apply the technology the right way, this is how you benefit everyone, the entire crypto community. If you don't apply your blockchain technology the right way, it will only benefit those who came in early, and everybody else will be just used as the exit liquidity. So always ask yourself, what is the function of the cryptocurrency? Is it retaining liquidity for me, or am I the exit liquidity? And thirdly, is its usage, which is volume, tied directly to its value, which is the liquidity? And are all participants incentivized? Are the traders, the holders, and the stakers incentivized? If you can answer all 4 questions with yes, then that's the platform, that's the proper ecosystem you want to be part of right before we get into the bull run. This is it for today, community. I hope this was informational, educational, inspirational to you. Let's not be misguided and rush for the price of cryptocurrencies. This is deceiving. It doesn't paint a clear picture. Always pay attention, not on the price of the cryptocurrency, but pay attention to its liquidity. Because at the end of the day, this is what counts. This is the true store of value. This is the meaning of being a store of value. And with Bullrun, you have best of both worlds. You have a store of value with deep liquidity, and once you decide to stake it, you receive a medium of exchange in the form of USDC. It's a win-win for everyone. So this is it for today, community. I hope this was informational, educational, inspirational to you. Look at this video as the first step for you to go down the rabbit hole and do your own research. With that said, I want to wish everybody a wonderful rest of their day, and let's keep in touch.